Hello, folks. Happy Friday. Welcome to this episode of Rich Insights. I'm Don Rich, the head of investments for Esoterica Capital Management. Today's topic is making sense of the environment. Now, my father used to tell me that you should never slap a man in the face that's got a cheek full of tobacco. I never quite understood that expression, but I believe it means we shouldn't look a gift horse in the mouth. But I want to do just that today. There's some things that just don't seem to make a lot of sense to me right now. So far this year, if we look at the NASDAQ, right, the tech-heavy NASDAQ versus the S&P 500, the broad-based measure of U.S. equities, tech is outperforming the S&P by about 5%, about 500 basis points. One's down about 14%, and the other one's down 18-19% for the year right now. The thing that was surprising is during the pullback, tech consistently would hold up better than the S&P 500. On most days, the NASDAQ was outperforming or losing less money. The NASDAQ was losing less money than the S&P 500. Now, the reason that's surprising is that tech is supposed to be the riskier asset class. It's supposed to be more cyclically sensitive. It's a high beta, right? It's supposed to move more when markets are moving up. Higher beta stuff tends to move up faster than the market, and when the market's moving down, they tend to underperform. But that's not what we saw this time. Now, I think the reason that things appear to be screwed up, why tech was performing as a defensive, is for three reasons. One, its ability to generate cash flow, right? Free cash flow generation. Free cash flow is cash a company generates after it pays off its operating costs, right? And the tech firms are doing that quite well right now. So there's free cash flow. There's also the strength of their balance sheet. And why is their balance sheet so strong? Because of the leverage, right? The third thing is the lack of debt that these firms tend to have. The industrial firms, right? The older U.S. firms have been taking on more and more leverage over the past few years. And they got themselves in a bit of a pickle right now. Their balance sheets are levered quite heavily. All right, so I think that's why tech was outperforming during the pullback. Well, let's take a look at yesterday. Yesterday was a big day in the market, right? You can see the Dow up here about 6.5%, just shy of 6.5%. The S&P 500, the Dow, by the way, has 30 stocks in it, so it's just like a subset of the S&P 500. The S&P 500 was up 6.25%, not quite as much as the Dow. And then we got the NASDAQ here at 560. So we're trying to decide, is this a bear? Is this a dead cat bounce in a bear market? Or is it something more? And as I look at this, I do get concerned that tech is underperforming the broad market and by quite a bit. Now, if we take that 625 here, the 6.25, and we break it down, that's what the bottom chart's for. Right? The bottom chart's down here to tell us where that 6.25 is coming from. The best performing sector yesterday was utilities, and the second best performing, real estate. If this was a breakout environment, for those that want to buy the dip, if this is a breakout environment, would you expect the most defensive sectors to be leading the charge? Utilities and real estate have the closest thing to fixed cash flows. They're fixed income like. So if this was a dog that was about to get off the porch and run, I would expect the more cyclical sectors, right? Consumer discretionary, tech, consumer services. Let's take a look at some of these. So tech yesterday was essentially the same as the market, right? Market 625, tech was 635. Consumer services, this one has the Netflix, Google, Twitter. All right, so it has some of the old tech firms in it. It slightly underperformed the market here at 6%. And consumer discretionary was actually the worst performing one. So that makes me think, that makes me wonder, that makes me believe that all we're seeing is a dead cat bounce. We are seeing panic buying, I believe. All right, last week we had panic selling, right? During the downturn seemed to get excessive, and at the end, there was nothing more than the just get me the hell out mentality, right? That's panic selling. Panic buying, on the other hand, to me, are those that are afraid they're going to miss the relief rally. So they want to stick their toe in the water, but they don't want to put much risk on the table. They want to stick their toe in the water in the least risky fashion. Right? They don't have confidence that this is, again, a dog that's about to get off the porch and run. It very much looks like a dead cat bounce. Now, the last thing I want to talk about today is the move. 6.25% moves in a day. Wow. These are big moves right now. And I think that choppy environment, the choppiness, is going to continue. Many of you may not know, but you can actually invest in volatility. All right, volatility is not whether or not stocks are going up and down. Volatility is how much stocks are going to be bouncing around. And you can actually invest in that. So, as we look at the market and see what they think volatility is going to be, right? That the market tells us what they think volatility is going to be over in the next 3 to 4 weeks. It's something called a VIX, by the way. Volatility is still expected to be quite high. This choppiness is expected to be quite high. Now, how high? All right. Well, a VIX of 60 means a daily return of 4% is not unusual. We should not expect that to be unusual. Wow. Can you imagine that? A 4% move, whether it goes up 4% in a day or down 4% on a day, the fat guy's telling you, don't get excited. It's just the rules of the game right now, right? It's essentially noise. It doesn't tell you a damn thing. That's hard to believe. But that's the environment we live in right now. You've got to realize if you want to play this dead cat bounce, if you want to buy this dip, there is tremendous risk associated with it. And we should expect this choppiness to continue. All right, that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you have enjoyed it. May your beer be colder than the company you keep. Talk again soon. Thank you.